Hi, and welcome to Wealthion. I'm James Connor. And before I introduce you to our guest, I have one ask, and that is subscribe to our channel, wealthion.com. And also hit that notification button to be kept up to date on future events. We release interviews 5 days a week, and we have some amazing speakers coming up in the coming days, all of which will help you navigate these financial markets. And now I want to introduce you to Brian Sponheimer. Brian is a portfolio manager and auto analyst at Gabelli Funds, and Gabelli is an asset manager based in Rye, New York, and manages over $29 billion in assets. Brian is going to take us through the auto industry and the health of the auto industry and determine if now is a good time to buy a car. Brian, thank you very much for joining us today.
Thank you very much for having me.
Before we do the deep dive on the auto industry, I want to get your thoughts on the broader economy and if there's anything that concerns you about the current economy or if there's anything that keeps you up at night.
Yeah, certainly. I guess our job is to worry here about any and everything that can get in the way of economic progress and what could help the stock market. But I think broadly speaking, the economy is in a decent glide path right now. On January 31st, you had Fed Chair Powell stating that the Fed needs to see more evidence that falling inflation is sustainable. I think we've seen some economic indicators show that an economic acceleration is in fact underway, which puts some hope that the Fed will start to reduce interest rates in the middle to the back half of this year. Obviously, as an auto analyst, that one of the things that we're always worried about is vehicle affordability, and the interest rate that consumers are paying on their loans is in some ways directly correlated to the Federal Reserve, the Fed funds rate. So, it's somewhat encouraging. But right now, vehicle affordability, whether it's across new vehicles, used vehicles, is what's first and foremost on my mind. And I think we'll probably talk about that as we get into the next half hour, 40 minutes or so. But I would say, thinking about the economy, employment seems to be fairly tight right now. If inflation is sticky anywhere, it's in labor, which is good from a consumer standpoint. The consumer is earning more. It could certainly bite into corporate profits a little bit, but I think we're looking at an economy where consumers are not necessarily worried about losing their job because another one's right around the corner. I think affordability is definitely something that is a factor in whether it's housing, autos, anything from a durable goods category is concerned. But broadly speaking, we're in a relatively healthy environment here.
So let's examine the auto industry from a top-down approach. I want to determine just how important this industry is to the U.S. economy. Maybe you can just take us through how important it is to the GDP and how many people it employs.
That's great. So the U.S. economy, the auto industry is about a $1 trillion industry. It's about 5% of the economy. And if you think about all of the components of that ecosystem throughout a vehicle's life cycle, it is everything from not only the automakers themselves in the U.S., the Fords, the GMs, the Stellantises, but also the foreign automakers that are here, whether it's BMW, Honda, et cetera. And then there are hundreds of what are known as tier one suppliers. Those are the suppliers that are directly to the auto industry or the automakers rather. And then there are tens of thousands of tier two suppliers. So thinking about all the systems and subsystems that go into making what is outside of an airplane the most complex piece of machinery that you or I will get in. It is an industry that just from a manufacturing standpoint has tens of thousands of participants from a company perspective. And then just thinking about the ecosystem of how those vehicles are sold through dealer networks, about 16 million cars are going to get sold this year in the U.S. That's a fairly typical year. About 40 million used vehicles will get sold. So there's about 18,000 or 17,000 or so dealers in the U.S. that sell new vehicles. Those are franchised auto dealers. There's about 35,000 used vehicle dealers in the U.S. And really thinking about how integral those auto dealers are to local local economies and how integral those auto suppliers are to local economies. It's a massive industry in the U.S. It's an important one, and it's one that really drove economic growth and prosperity for the better part of the last 50 years for the U.S.
And just to summarize, you said 16 million cars will be sold in 2024?
That's right. That's somewhere in the range of 15.5 to 16 million. That's roughly flat to up from 2023.
And I know the last few years have been somewhat distorted because of the pandemic, but how would those numbers compare to before the pandemic?
So for the better part of the decade prior to 2020, the U.S. ran somewhere in the range of 16 to 17 million vehicles. I think a few factors drove that range to be a little bit higher than where it's going to be this year, and we can talk about that. Vehicle affordability being a major component of that, with really a decade of 0% interest rates playing a major role there. I think too, one of the things that we can talk about is inventory on dealer lots. So prior to 2020, there were roughly 3.7 million units of inventory available on dealer lots. What happened during the pandemic was that April and May of 2020, effectively zero cars in North America got produced, really just a few thousand. And inventory went from 3.7 million units, eventually down to about 900,000 units. So about a 75% decline in the U.S. And really that was true across all of North America. And what happened during that time period is that dealers and automakers were able to charge significantly more for the vehicles that they actually had on hand, and they learned that the per unit profitability rising as much as it did, they actually generated more returns from a profit standpoint than they had been when they were selling more vehicles. So as we have started to get industry production back up to a level where supply chains are not really the mess that they've been, really everyone in the ecosystem is realizing they don't need to produce as much as they did before, and they can generate greater profitability on a per unit basis just by having a little less inventory than they had before. And we're at about 2.4 million units back on dealer lots, and again, that's down from 3.7 million units prior to the pandemic. So it's a long-winded answer to a very short question. We used to sell a few 100,000 to another million or so more vehicles prior to 2020. Obviously, we've recovered back almost to where we were before.
So it sounds like the American consumer really got screwed during the pandemic by the automakers.
Well, if you, it depends on that definition. I think it was simply a supply demand equation where consumers that desperately wanted a new vehicle had to pay more, and if you didn't necessarily need to buy new, you could have at least initially chosen the used vehicle market. Now, used vehicle prices also went through the roof during the pandemic. So, from a supply demand perspective, it was a difficult time if you were really in need of buying a new vehicle or a used vehicle for that matter.
And when you were talking about those inventory numbers, those are new cars. Is that
That's
correct?
Right. Yeah.
Right. And so why don't we just touch on the used car market? I think you said there's 40 million sales last year.
Yeah, about 35 to 40 million used units get sold every year. Clearly, that's a function of, in part, how many new vehicles get sold. So one thing we're seeing right now is that the supply of available 0 to 4-year-old used vehicles is very low. That's based on the amount of vehicles that were produced in 2020, 2021, and 2022. So you think about an industry that gets a lot of its vehicles from the off-lease market. Leasing really dried up during the pandemic. And because of that supply-demand imbalance, dealers are really hesitant to sell used cars for anything less than the maximum amount that they could get for them, because they didn't really have to sell those units. So you've got an industry that is healing a little bit, but the used vehicle market is generally a little bit more stable than the new market. If you think about it, in times where the broader economy isn't quite as robust as it can be, Used vehicles are a good substitute for buying new. So you tend to see a little bit of a lower amplitude as it relates to the cyclicality of the used market, and it makes for a very good market from an investability standpoint for what we do.
And I just want to expand on that a little bit. From okay, if you're an automaker, where are the margins better? Are they better with new cars or with used cars? And if you're a consumer, where do you get a better deal? Buying a new car or buying a used car?
So once from an automaker's perspective, once that vehicle gets sold to a dealer, they don't have any they have no more claim on that vehicle. So it's really the profit on the new or the used cars is really at the dealer level. The per unit profitability from a dollar amount is greater on a new car than it is on a used car. Just think about a brand new car is going to be significantly more expensive than a used car. So the per dollar amount will be better. The profit margins on a used vehicle are typically better than they are on a new car, and we're talking about a typical period, not necessarily the one that we've been in the last couple of years, but what had traditionally been a market where a used car dealer would have greater information as to the quality of the used vehicle that they were selling, and be able to generate a greater margin on that vehicle selling a used car to a consumer. It's one of the reasons why the used car market got such a bad reputation for the better part of the last 50 years. So consumers always felt like they were getting ripped off buying a used car. There's a lot that's changed about that, which I think is really positive, and we can talk about that a little bit, about pricing transparency and consumers knowing exactly what they're getting, certainly more than they would have in the past. There are some leaders in the industry right now that are really doing a good job from a best practices standpoint there, and they're gaining share, the CarMaxes of the world. So the used market has certainly evolved quite a bit over the last 20 years, but really accelerated within the last decade.
No, I do agree. I always feel I get ripped off when I buy. It doesn't matter if it's a new car or a used car. I always
Right.
feel like I'm getting ripped off. But before we go down that road, I want to just clarify one thing, what you said about margins. So when I go into a dealership and I buy a new car, what are the typical margins for that dealer?
Yeah. So on a margin on a new car, without any of the real exogenous factors that we've seen over the better part of the last few years, are usually in the 5 to 6% range. It could be as low as 4.5%, depending on the automaker and the brand. And used margins are usually in the 6 to 7% range. Can be as high as 8 or 9%. Dealers are terrific businesses, not necessarily because they make so much money selling new and used cars, but it's the attach factor from the parts and service business that really drive what a dealer's profitability. Dealers want to they are in the selling business, not the holding business. So typically speaking, when they get a piece of inventory in, they want to get that vehicle back out the door.
And when you look at a high-end car, let's just say a Mercedes or a BMW, I'm assuming the margins are far better on that than they would be on, say, a Ford or a GM product. Is
Yes,
that the safe assumption?
that's right. You have a not only is the profit dollar amount going to be bigger, at that level, you've got a consumer that is less likely to really battle from a price perspective, and so that they're more willing to pay a little bit more.
And in terms of the longevity of cars now, cars can last a long time, but what's the average age or the average number of years that consumers keep cars for?
So there's about just under 290 million cars on the road in the U.S. There's about 1.3 trillion on the road around the world. And in the U.S., the actual average age of those 287 million cars is 12.7 years. So that's the oldest on record. And that's for a variety of factors, not the least of which is that cars are just simply getting built better than they ever have before. You've also, and we've seen step changes in the past from an aging perspective, but the materials used in a car now are significantly more durable than they were, say, 30, 40 years ago. You have non-corrosive metals. There's certainly a lot less rusting that goes on in vehicles. So, consumers are holding on to their cars longer. And then the technology in the vehicle is iterative to a degree, and that's allowing consumers to be able to hold on to the vehicles a little longer as well.
Man, I can't get over that. 12 years. That is a long time. I typically keep mine for 5 or 6 years, or I try to anyway. I guess it all depends on mileage.
Right. Well, a typical car, lasts 17, 18 years, and will have 3 to 4 owners. You have that first owner that owns it for the first 5 years until it comes off a warranty. Someone thereafter will buy it at 55,000 miles or so, and drive it for another 6 or 7 years, and then someone else will take it and drive it, so to speak, until the wheels fall off. It actually creates a very healthy automotive aftermarket. We have followed the industry for the better part of the last, really since our inception 47 years ago, 48 years ago. This will be the 48th year that we've had an automotive aftermarket conference in Las Vegas in November, where we bring in a lot of industry leaders of companies such as AutoZone and O'Reilly, and some of the larger auto dealers, and thinking about servicing those 285 million or 290 million vehicles, and how steady that industry is relative to, say, a new vehicle dealer selling into a 17 million unit market. That has been an area where we've had a lot of success in finding really good ideas from an investment standpoint.
So let's talk about some of the changes happening within the auto industry. It's being disrupted on many fronts. You have EVs, autonomous driving, ride sharing. So I want to discuss these topics. And why don't we just start with EVs? That seems to be the biggest change in the industry, but they've exploded in recent years. In 2020, global sales for EVs was around 3 million. And then by 2023, I believe the number was around 15 million globally. But maybe you can just touch on that, because it does seem like the number or the growth or the rate of change within the EV industry is starting to slow. But maybe you can just give us your views on that and what it means to the traditional car market.
So I think it's important to think about the EV growth in terms of the geographies where that growth is really taking place. So clearly China has been a leader in electric vehicle adoption. It's clearly been funded through subsidies by the Chinese government, and it's led to really a massive expansion, not only by Tesla entering the market, but also BYD is the largest electric vehicle manufacturer in the world. It's a Chinese automaker. We've seen massive changes to emissions regulations in Europe, causing greater adoption there, and the use cases for electric vehicles are probably a little bit better in Europe, where consumers aren't driving quite as much. In the U.S., electric vehicles were about 8% of new vehicle sales this past year. Clearly, Tesla has been at the forefront of EV adoption for the better part of the last decade. You're now seeing newer models come out from your traditional automakers, really up and down the price spectrum, everything from $35,000 models from GM and Ford to upwards of $150,000 models from the Mercedes of the world. And what we've seen is that a lot of the demand from early adopters has already taken place. And we're entering this period now where, in order for greater EV adoption in the U.S. to take place, the product needs to not just be an electric vehicle by name. The vehicle is going to have to look and feel like the SUV and truck market that the U.S. market really is. And I think we're in this this time period where those models are just now getting rolled out. And right now, electric vehicles are still more expensive on a comparative basis relative to internal combustion engines. That's come down quite a bit, and we're getting near parity. But on an apples to apples basis, an EV is going to be more expensive. We have to have a rollout of electric vehicle charging infrastructure that takes away some of the range anxiety that consumers have about electric vehicle adoption. And just thinking about how vehicles are going to get charged, roughly speaking, about 50% of U.S. households don't have garages. So the ability to charge your vehicle overnight is something that that is slowing that adoption right now. So we're in an interesting time as it relates to EV. I think you're going to see hybrids come back into the vanguard a little bit more. You will clearly see a greater electric future. It's just a question of when. I think, though, and this has really been the way that we've approached it, we're measuring progress on this in 5-year increments as opposed to the whole world going or the whole U.S. getting to EVs by 2030.
Yeah, it almost sounds like an impossibility, but you make an interesting point too about the cost to maintain these. Hertz recently announced that it was discontinuing EV rentals and it's going to be selling 20,000 cars and then replacing those with your traditional cars. But a lot of that had to do with the cost to maintain them. Can you speak to that?
Yeah. So, as I mentioned before, there are about 17,000 dealers in the U.S. that help to maintain the 0 to 5-year-old car population. Tesla rolled out a really an ownership model that didn't use dealerships. It's direct sales. They have fewer service locations, and I think one thing that we have found is that when electric vehicles have service and maintenance issues, that the interval time period to fix those vehicles is quite a bit longer. It has to do with parts availability, has to do with a lack of supply of properly trained technicians, and the repairs are more costly. So as it relates to Hertz, and I think it's worth mentioning, Hertz bought upwards of a tenth of their U.S. fleet in electric vehicles. So we're talking about 50,000 cars. And in that time period, Tesla decided to cut prices by about a full third on new vehicles. And so a vehicle that used to cost $60,000 is now going to cost $40,000 or so. Think about what that did to the residual value of Hertz's fleet, and so they've had massive issues as it has related to depreciation of their fleet and what they had originally expected to sell those vehicles for versus what they're actually going to be able to sell them for. So it's a two-pronged problem. The units that they had, and if you think about a rental car company, they're really an asset manager, right? They buy physical assets and then they have to get them out. Those assets aren't generating any revenue for them while they're waiting on service. So they had an issue with those vehicles from a dependability perspective, given that the repairs cost more and they took longer to do. And at the same time, those vehicles were depreciating at a rate that was faster than originally anticipated because prices kept coming. Tesla kept cutting price on the new vehicles that they were selling.
Yeah, very interesting points, and I never really looked at it like that before. But I guess that also Tesla's aggressiveness also had a big impact on other OEMs like Ford and GM that were trying to push out these EVs too.
That's right. Yeah. So we we had seen some fairly promising models come out from Ford in particular with the F-150 Lightning. That really stood alone in the industry until recently, as far as being the only electric pickup truck that was available, but also the Mustang Mach-E. And so, that was really kind of a direct competitor to the Tesla Model 3 and Model Y. And so when Tesla started cutting price, clearly a direct impact there that I think a lot of the industry is still coping with.
And Tesla recently released their numbers. Maybe you can just give us your thoughts on what they said.
Yeah, a really interesting quarter. Tesla right now is sort of between growth periods, according to the company. They have really 4 models that they sell: the Model S, the Model X, the Model 3, and the Model Y. And they've been out for a few years. They think that they're going to have a smaller, more affordable vehicle available for consumption or for sale at the end of 2025. Tesla's track record as it relates to hitting time period targets hasn't been necessarily the best. So they produced and sold about 1.8 million units this past year. I think the broader street is looking for roughly 2.1 million units. So you're talking about a growth rate for the company that's less than 10%. And the question really is for investors as they think about Tesla stock, what are they willing to pay for that growth? How much of Tesla's market capitalization should be attributable to some of the other potential industries that Tesla could enter, some of the AI or autonomous solutions that they could potentially be a major part of. And I think that that's something that growth investors are really struggling with right now. So when the stock's down roughly 30% over the first 35 days of the year. So it's going to be a really interesting year as it relates to Tesla. We're value investors, so Tesla, while being a company that we have a real close eye on, is not necessarily one that are where we look to for investment opportunities. As I mentioned before, we spend a lot more time with the dealers and with the automotive aftermarket, where cash flows can be a little bit more predictable, and where some M&A opportunities may be really fitting into our own methodology as investors here.
And so that's a good overview of what's happening with EVs. But what about autonomous driving? How is this impacting the industry, and also ride sharing?
Yeah, so from an autonomous standpoint, I think a lot of the exuberance and enthusiasm that maybe was there 5 or 6 years ago has really taken a back seat to some of the broader obstacles that is really one of the most amazing engineering challenges that anyone has ever seen. What we have now across most automakers is what's known as level 2 autonomy or level 2 plus autonomy, where you can get onto a highway and then go hands-free. This is the Tesla FSD, which was previously called full self-driving, Super Cruise out of GM, and there are various other names across the Mercedes, BMW, and other automakers that are able to have level 2 plus autonomy. When we're thinking about the purely autonomous solutions that are being explored by Waymo and by Cruise, what they have found is that the first 90% of autonomy was, I guess, the relatively easy part. It has a someone who's not a scientist or not an engineer, I think it's simplifying for me to say. But when you talk about urban environments and robo-taxis and the ability to navigate areas like San Francisco, where there's really an infinite number of variables that are needed to take into account to create a safer driving experience than one would have if it was a human driving, it's proven to be a massive challenge. And I think we've seen that from some of the some of the steps that GM has had to take recently with Cruise as it relates to almost shutting down the program and taking a step back from a growth perspective relative to original ambitions. In 20, before the pandemic, Elon Musk was talking about 1 million robo-taxis available for Tesla owners. If you had owned a Tesla, it was going to become a robo-taxi within a year and a half or so. Obviously, that didn't take place at all. And in fact, those cars are now 5 years older than they were before. So we're talking about those cars potentially being sold and new vehicles being bought that don't necessarily have that promise that that was offered 5 years earlier. So autonomy really taking a step back. However, the implementation of active safety measures such as automatic emergency braking and radar, basically your bumpers now for a new car is a very expensive sensor. That adoption, I think, is making the vehicles significantly more safe. It's also impacting areas like the collision market, where vehicles are being labeled as totaled considerably earlier than they ever would have been in their life cycle, because the cost to repair a bumper is now in the thousands because of all this technology for active safety that is in that part of the vehicle, both front and back.
Another big trend within the industry is consolidation by large corporations. You mentioned earlier that there's approximately 17,000 dealerships in the US. And a lot of these large companies like AutoNation, Lithia, and Penske have been consolidating them. But what does this mean for the auto industry overall? And I guess, what does it mean for the consumer? Are we getting better deals because of this consolidation?
Well, what larger corporations have done, like AutoNation and Penske in particular, on the volume side, so not necessarily in the world of premium vehicles, but certainly within the Toyotas, the Hondas, the GMs and Fords, et cetera, is they've gone to a no haggle pricing model in a lot of cases, and so consumers are going into dealerships now, and the price is the price. And I think that has created a better buying experience for consumers than the experiences that you or I spoke to earlier on this recording, where you go in and you feel like you're dealing with a seller that knows more than you do, and you come out feeling that the experience was gross. What the consolidation of that dealer industry, and if you go back 10 years, that dealer number was in the 20,000 range, or I guess now 15 years ago, in that 20,000 range. That consolidation, I think, is creating a better user experience than consumers would have otherwise had in the past. You're getting more locations to service your vehicle, and you are having a really more professionally run organization get better standard operating procedures. So I think it's been, generally speaking, a positive for the consumer experience. At the same time, in a lot of cases, dealerships are really entrepreneurial industry. Sorry about that, but you've got owners that are very smart owners. In a lot of cases, when this consolidation takes place, Lithia will say, "You've been a great owner for a long time. We're just going to help you from an operating perspective, but go out and run your business the way you see fit."
You raised some interesting points there, but I have to admit I have a real love-hate relationship with these dealerships. I love going in and checking out the new models, but I hate the whole negotiating process, because that still goes on with a lot of dealerships. And I always feel like I'm getting screwed over. And there's always like 5, 10, or 20 different additional fees that they add on, additional taxes. And so you never know what the real cost is. And then they're always pitching you on other features like tire insurance, for example. But as a consumer, how do I know I'm getting a good deal?
Yeah, it's a good question. I think what's happening now is that so much of the process of buying a new car or used car is able to be done online beforehand. And so you're getting a lot of that transparency that you never had before when you are going shopping as a consumer, and that is really up and down the spectrum of whether it's a brand new car or whether it is a 10-year-old vehicle that's being sold at a CarMax, where you're getting 30 different high resolution pictures about a vehicle. You're getting a Carfax incident report from any major accidents that the vehicle has had over the course of its life cycle. You're getting better information about, you mentioned tire and wheel insurance, which depending on where you live, can be a very valuable investment in your car, and in other places where it isn't a concern, is a waste of money. So, to your point, every 5 years or so, a consumer goes in to buy a new car, and what I think has happened is that if someone had gone in 5 years ago, their experience would be maybe a little bit less cozy than it is now. But there's a lot more transparency now, and I think that's positive for the consumer. And I think it's, generally speaking, positive for the dealerships in that, while they may be losing a couple of dollars on the margin that they might have squeezed out of a consumer 15, 20, 30 years ago, having that better experience is leading to greater customer retention, and that's really what a dealer wants, particularly as it relates to parts and service. They want a customer walking out thinking that they had a great experience at the dealership, so that when it's time for everything from major repairs to a car to oil changes to anything from a repair and maintenance perspective, that they want to go back to that dealership and because they were treated fairly.
So you're suggesting before I go in and buy a new car or a used car, I spend a few hours online just trying to determine what the correct price is?
You can actually get almost all of your transaction done online now, and really depending on where you live in the U.S., and this is on a state-by-state basis, you could get the entire transaction completed with you knowing exactly what everything means, but knowing exactly what you're buying. Some states still require actually ink on paper as it relates to signatures, but I think you're able to spend as much or as little time examining what you're buying more than you ever could before.
So the other aspect to this whole process is parts and service.
Yep.
You always get those notifications on your car saying, okay, you're at 500 miles or whatever the number is. You got to bring it in for maintenance. And then you go in there, and next thing you know, it's like $500 or $1,000 for basic maintenance.
Right.
Well, I'm curious, what are the gross margins associated with that aspect of the business?
Yeah, so that's about half of a dealer's profit that they're making through roughly 13% of the sales of the dealership, and margins can be up in the 50% range. So there's an attach rate that comes with that 0 to 5 year old car, where a lot of the engine work that's going to get done is protected by warranty. And then there's an entire ecosystem of good, better, best from a parts perspective and from a cost perspective. So that's partially why once a vehicle is out of that 0 to 5% age range, you're going to the independent aftermarket. You're going to find the up and down the street garages to get your vehicle fixed, because the prices at a dealership are what they are. They're considerably more expensive, and there's a massive industry out there that exists to help consumers who don't want to pay that.
So as you know, the U.S. economy is very strong, growing at 5% annualized. The jobless rate is very low. CPI is coming down. And when we look at all these different aspects of the auto industry, including new sales, used sales, and all the different trends that we just spoke about, where is the auto industry going in 2024, and what does it mean for the overall economy?
Yeah, I think it'll be a relatively healthy year for the industry. And if we think about the various parts of that ecosystem that we talked about. The automakers will have a relatively good year. They still want to put a little more inventory on dealer lots. There will probably be some negative pricing because that inventory will come with a gross margin impact that'll be lower than this past year, but still a very good year for the broader industry. The used market is going to be in a year of transition still, as that 0 to 5-year-old or 0 to 3-year-old car population repopulates. And we just simply need to sell more new cars to populate that industry 3 or 4 years later. The automotive aftermarket should have a relatively decent year. Obviously, that aftermarket supports that 290 million unit car population that comes with consumers of every cohort of the income bracket. So, what would concern me at the margin is affordability of parts for that aftermarket. We're about halfway through a winter here, where harsh winters have a really big impact on vehicle maintenance, and so we'll see what happens over the course of the next 6 weeks or so. From a personal standpoint, I hope it's a very mild winter, but from an investor standpoint, cold and icy winters are excellent for some of the stocks that we invest in. So we'll see what happens there. So I would say 2024 shaping up to be a relatively decent year for the industry. Vehicle affordability will remain at the top of my list of concerns, as does, from a broader perspective, geopolitical impacts on Asia and Europe from the perspective of some of these global suppliers that we cover. But it should be in the U.S. It should be a relatively decent year.
So just to summarize all that, as it stands right now, there's no concern for you with the auto industry, and you don't see any slowdown in the U.S. economy from all the data you look at.
There's always concern. I never ever sleep well on anything. I'm always looking for what, we're value investors, right? We look down before we look up. But right now, I think we're in decent shape, with some cracks on vehicle affordability, rising rates starting to have a bit of an impact. But I would say things could certainly be worse.
And one of the other questions I'm always faced with when I'm looking at a new car is, it better to buy or lease?
Well, leasing availability is actually coming back a little bit. You saw the automakers and their captive finance companies pull back on leasing when used vehicle prices went through the roof in 2021 and 2022. I would say if you are a consumer that's going to put 12,000 miles on your vehicle, or 18,000 kilometers, you are in a good place from a leasing perspective. If you're someone that does a lot of driving, like I do, and I think like you do, then ultimately leasing probably isn't for you. But there are people that love the leasing experience. Every 3 years they get a new car, and it's one of the reasons why it's over 50% typically of what Mercedes and BMW do every year.
And given everything you said right now, for the consumer, from a consumer point of view, is it a good time to buy a car?
Well, if you're if you're of the opinion that rates are going to be dropping in the next 6 months, and you're able to wait, then waiting might not be a bad idea. I'd expect, though, that commensurate with that, the price of the car that you have right now is also going to depreciate as well. So I think it's a decent time to buy a new car. Certainly, maybe not as good as it was 5 years ago, when rates were much lower, but a decent time. And there's some really exciting technology that's going to be a lot different than what you had 7 or 8 years ago in the last car you bought.
Brian, as we wrap up, if an investor would like to hear more about your thoughts on the auto industry or learn more about Gabelli Funds, where can they go?
They can go to Gabelli.com, where they can see a list of our open and closed-end funds. Additionally, we do have a large separately managed account business, so they can contact us there. But our website is Gabelli.com, and certainly um, any auto-related questions that can be put through the general website as well. So I appreciate you're giving me the opportunity to speak our own church here.
No, that was a great overview, and I learned a lot about it because, like I said, I have my concerns about this whole industry when I go in to buy a car. But
Sure.
anyhow, I want to thank you very much for spending time with us today, and I look forward to our next discussion.
Oh, thank you very much for having me, and really appreciate the opportunity to talk about what gets me excited.
Well, I hope you enjoyed that discussion with Brian Sponheimer and you have a better understanding of the auto industry and how it impacts the overall economy. If you have any suggestions on who you would like to see interviewed on Wealthion, let us know in the comments section below. One of the reasons we do these interviews is to help you determine what's happening in the economy and how the economy might have an impact on your financial future. And if you need understanding in how to prepare for your future, consider having a discussion with a Wealthion endorsed financial advisor at wealthion.com. There's no obligation to work with any of these advisors. It's a free service that Wealthion offers to all of its viewers. Once again, thank you for being with us today, and I look forward to seeing you again soon.